Hi everybody, this is AJ speaking. Today I wanted to briefly discuss Stellantis' first half results, which just dropped. Stock reacted negatively, down another 4.3%. Stock was down yesterday already 4.2%. Yesterday's drop was primarily driven by the announcement of the US-European Union trade deal, which inflicts 15% tariffs on all EU exports to the US, but zero tariffs on all US imports to the European Union. Currently, it's end of July, and year to date, the stock is down almost 26%. But to understand what's going on with Stellantis, we need to zoom out a bit. Now you're looking at the last 5-year share price development. Stock is down almost 10% over the last 5 years. Given market is up massively over this time period, this means the stock dramatically underperformed the stock market. Stock is currently at $9.30 pre-market, but as you can see, stock almost touched $30 per share in April 2024. But now let's look at what's going on. And this is what you see on this table that was published this morning. And you can see down here at the bottom, the most important financial metric for an automaker. This is free cash flow in the auto business. Stellantis calls it industrial net. Sorry, wrong table. That's the right table. Stellantis calls it industrial free cash flow. And this number came in at a negative 3.0 billion euro. These numbers are in million. This is the superior free cash flow metric in an automaker that has material financial services business like Stellantis, because financial services create significant volatility in free cash flow that are kind of meaningless. And that's why you need to look at the auto free cash flow, and as I said, in Stellantis' case, they call it industrial free cash flow. You can also see that in the first half of 2024, they already lost just under 400 million euro, i.e. generated negative free cash flow of just under 400 million first half of 2024. But then when you look over here, the picture was quite different. So in 2022, for the full year, Stellantis generated just under 11 billion of positive free cash flow, and then just under 13 billion of positive free cash flow of 2024. And then in 2023, just under 13 billion, and then negative 6 billion in 2024. So you can see something quite dramatic happen here. And what happened is actually what I predicted at the end of 2023. And you have to keep in mind, when Stellantis reports the second half of 2023, it's in the first quarter of 2024. So I was way ahead of the wave. So let me just pull up real quick the receipt. So here's the analysis I shared on October 31st, 2023. And then I'll quote my own post. Stellantis' cash generation is likely to decrease in the second half of 2023. Here is why. In the first 6 months of 2023, Stellantis' free cash flow of 9.7 billion made it the global automotive leader in this metric. This analysis suggests that Stellantis likely peaked in the second quarter of 2023 and faces headwinds in the second half of 2023 since global vehicle shipments decreased by 17.4% quarter on quarter. So Stellantis does not provide quarterly financials, but it does provide a quarterly revenue and shipments, but no other financial metric. No gross profit, no operating profit, nothing. Then the second point I made was that global inventory continued to increase, plus 0.9% quarter on quarter. I then continued on by saying this analysis is complicated due to the absence of quarterly free cash flow data from the company, leaving us in a state of speculation until Stellantis releases its fiscal year 2023 financials in February 2024. So my prediction came about 4 months before the data hit. So when we go back to the share price chart, you can see that at that point, Stellantis hit around $25 per share and then even traded up further, as the market still didn't get the financial performance of Stellantis, even though it was clear from the sales and inventory data. So this chart then shows you what actually happened. So my prediction was in October 2023. So this was here, second half of 2023, but this number was not yet available. This number was reported in February of 2024, so at that point. And then you can see how it quickly went downhills for Stellantis. After the second half of 2023, all subsequent reported periods saw a significant negative free cash flow. So how was it possible I could predict this? It's actually not rocket science at all. And because I want to make this a very quick update, I will not go into all the financial details, but the big picture was the following. And it had to do with COVID. So first of all, when did COVID hit? The real effects of COVID first affected the auto industry globally from the second quarter of 2020. The market sell-off was already at the end of the first quarter, the stock market sell-off. But in terms of hard financial effects on automakers, that was from the second quarter of 2020. And COVID had some somewhat counterintuitive effects for I would say the average people, and apparently also for the average investor who did not understand the automotive industry. So what happened is every automaker, including Stellantis, that went oversupplied into COVID experienced a massive windfall profit, because COVID had two main effects. One was that new vehicle supply was limited due to supply chain shortages because there were factory shutdowns and there was a huge turmoil in the global supply chain. Number two, there was a healthy demand for new vehicles. So you had all of a sudden an imbalance of vehicle supply and demand, favoring auto sellers, especially those that had plenty of supply on the dealer lot. The second point you need to understand is how these automakers sell vehicles. The customer to the automaker is not what most people think, the consumer that goes to a dealer, buys a vehicle, drives off. No, this is not the customer to these automakers. The customer is the dealership in most cases. There are some exceptions. For example, Tesla does not have a dealership network, so Tesla doesn't have customers that are dealers. Tesla sells directly to the consumer, so Tesla is everything I talk about here does not apply to Tesla. It applies to almost all legacy automakers. So the next concept you need to understand is wholesale versus retail. So wholesale is sale to dealership, and retail is what we as normal people understand as a real sale. But for the financials of an automaker that sells wholesale, the wholesale number is what drives revenue, cost, etc., earnings recognition. So now with that kind of basics out of the way, we can explain why this was highly predictable, why this high cash flow was unsustainable, and why it was highly predictable that it would come down. So before COVID, Stellantis and General Motors and a bunch of other automakers were totally oversupplied. That oversupply that was sitting on dealer lots was already booked in the accounts of the company, so was reported as earnings per share. Because again, the sale onto the dealer lot matters to those automakers, not the sales with which the consumer drives away. So then what happened is COVID hit, there was less supply, real consumers bought the vehicles and depleted the dealer lots. All this happened during periods of high inflation, strong pricing for vehicles. So these automakers, they made all killer margins by automotive standard. And because very high outlier margins in the industry are never sustainable, the margins also had to come down. So this was another effect that was a kind of one-off in nature and was predictable to come down. But now comes the kicker and what explains primarily the very high cash flow generation. The kicker was that because of the COVID situation, dealer lots were depleted. You could see much fewer vehicles than you would typically see. Typically, you can see them full. So there was no space on dealer lots. And because of the high margins, everyone, the automakers and dealers, they all make good money. So then later, as the supply chain issues were resolved, automakers started to supplying more vehicles to the dealers. But the kicker was they would not only supply the level of demand at the time, because there was now space on the dealer lots, because the dealer inventory was depleted, automakers could actually deliver more vehicles to the dealers than just what they sold. For example, let's say a dealer sells 50 vehicles a month, but now the dealer had, let's say, excess room, had available room of, let's say, 150 additional vehicles on the lot because the dealer's lot was depleted during COVID. The automaker would not only send that dealer 50 vehicles in line with that period's vehicle demand, but would send them 70. And because the sale to the dealer matters for revenue, cost, etc., recognition and cash flow, there was financial recognition beyond the underlying demand situation. So now you see how you could already predict that this at some point had to end, because at some point the dealers were oversupply or the dealer lot was full. And once that happened, the automaker could not send 70 vehicles per month anymore to the dealer. It had to send what the dealer was actually selling. So it would come down in this example to 50 a month. So this over recognition, as I would call it, had to stop. And because we know what's the approximate maximum inventory capacity, we could predict that sales would slow and come down. So that was number one. And one way to measure this typically in the auto industry is by looking at days of inventory, which is a metric that just measures how long would supply last if there was no new supply coming in. And typically in the auto industry, for a legacy dealership model, a healthy number is typically considered around 60 to 70 days. So if a dealer is not supplied within or for 60 or 70 days, inventory would go down to zero. And you might be thinking, oh, isn't fewer days always better? No, because there is some segment of customers who don't want to wait for the vehicle. They want to go to a dealership, they want to look around, pick a vehicle, and ideally want to drive off the same day or want to pick up the vehicle within 24, 48 hours. And that's why having inventory does make sense, even though it's very costly because it's highly capital consumptive. This is also why companies like Tesla have just a fraction of the inventory. For example, here's a quick look at Tesla's latest filings. This is for the second quarter of 2025. And here you can see global vehicle inventory days of supply. You can see this was at 24 days. And this is super low by global automotive standards, but this is because Tesla has a direct model. So Tesla doesn't have dealer lots. Tesla projects on a local basis vehicle demand, produces, makes them, and sends them out. And then there is demand matching. This is a big reason why Tesla is significantly more capital efficient. So this is the end of this video. I just wanted to share this insight with you real quick. It was really a shame that in Q4 2023 hardly anyone saw my analysis, and most likely nobody reacted to it because you could make so much money off it. The auto industry is really not that complicated. There's very good disclosure from industry sources. So a lot of stuff is highly predictable. And I think going forward, as everyone is totally focused on generative AI infrastructure, etc., there will be massive losers in the auto industry, especially as autonomy emerges. And I think there will be enormous opportunities. For example, my short in Stellantis is up over 50%. And especially when the market is very expensive, we have had a rally for a long time now, and the S&P 500 trades at over 22 times forward earnings. So at some time there will be a pullback. And if you have a short that performs well even during a market rally, it will totally print for you if there is a pullback. Next up on Stellantis will be a comprehensive financial deep dive, which I will be sharing with my subscribers on X to see how much juice might be left in Stellantis at this point. People previously thought when the stock was at $15, okay, this is over, it's dropped enough. Now we trade under $10. But this will be part of my next video. So if you're interested in deep dive financial research that provides actionable insights, consider following me on X, or better, subscribe to my research. I believe my subscription on X is the best bang for your buck you will find. With that, see you in the next video. Bye.